Welcome to Market Lens. Okay, if you've been watching the stock market lately, you are probably feeling some serious whiplash, right? The global economy is flashing all these warning signs, but stocks, they just keep soaring. It is a super confusing picture. But you know what? That confusion, that's where opportunity lives. So today, we're going to cut through all that noise and find the top stock ideas for November 2025.
So let's just start with the question that is on literally everyone's mind. Is the stock market completely broken? And look, it's a totally fair question to ask, because when you look at the surface, the numbers just don't seem to add up at all. I mean, this slide really gets to the heart of it. On one hand, you've got this huge pile of gloomy forecasts from all the major institutions, all of them predicting slowing global growth. But on the other hand, stock markets are trading near all-time highs. So how is that even possible? How can both of these things be true at the exact same time?
All right, to figure that out, we've got to look at this really confusing economic map we're all trying to read. Let's break down exactly why these numbers don't seem to make any sense. So the big picture, it's pretty clear. The global economy is hitting the brakes hard. We're talking about major institutions like the International Monetary Fund, and they're projecting a slowdown not just for this year, but for 2026 as well. They're throwing around words like dim, underwhelming, and tenuous. Yeah, you get the picture. It's not great.
And even the US, which has been this, pillar of strength, it's not immune. The projections show GDP growth dropping from almost 3% all the way down to just 1.5% over the next 2 years. And on top of that, the labor market, which was so resilient, it's finally showing some real signs of softening. Yeah, pretty much every sign is pointing in one direction, and that's down. And that brings us to the key that unlocks this entire puzzle, the Federal Reserve. Because how the Fed is reacting to this slowdown explains everything about why the market is behaving so strangely.
Think about this. Inflation is still a little sticky, right? It's still above their target. But despite that, the Fed has already delivered 2 interest rate cuts. And when you ask them why, their official reason wasn't about inflation being beaten. Nope. It was because of rising risks to employment.
This has completely flipped the market on its head into what people are calling a bad news is good news world. Every piece of weak economic data, like a soft jobs report, is actually seen as a positive. Why? Well, because it pressures the Fed to cut rates even more, and those rate cuts pump money into the market and push asset prices higher. So this rally, it's not about a strong economy. It's all about the hope for more help from the Fed. Okay, so how does all this macro stuff actually create an opportunity for us right now? Well, on top of this Fed-driven market, we have a really powerful tailwind for stocks that is pretty unique to this time of year.
You've probably heard the saying, history doesn't repeat, but it often rhymes. Well, listen to this. Historically, the 6 months from November through April are by far the best for stocks. We're talking an average return of 7% going all the way back to 1945. That is a huge seasonal advantage.
And if we zoom in even more, November, it's the undisputed champion. It is historically the single best performing month for the stock market, period.
But wait, it gets even better. In years just like this one, where the market is already up heading into November, the S&P 500 has gone on to post gains in November and December, a staggering 80% of the time. I mean, come on, that's one of the strongest historical trends you'll ever find in finance. But look, this isn't just some dusty old stat. There are real, powerful forces at play right now. First, corporate buyback blackout periods are ending, which means companies are about to unleash a flood of demand for their own stock. And second, retail investors are more active than they've been in years. You put those two together, huge corporate and retail buying, and you create this powerful supply and demand imbalance that can really drive prices up. All right, so the big question, how do we actually play this? We've dug in and found 3 high-conviction stocks that are basically a playbook for this exact market. First up is Universal Health Services, or UHS. This is our defensive growth play. The idea here is super simple. Healthcare demand doesn't really care about the economy, right? It's stable even when things slow down, and UHS is just executing flawlessly while trading at a really, really attractive price. Just look at this valuation gap. It's wild. UHS is trading at a price-to-earnings ratio of just over 11. That is a massive discount to its bigger peer, HCA. And look at its PEG ratio.
0.93. Basically, anything under 1.0 is often seen as a screaming deal for its growth potential. This is a textbook example of growth at a reasonable price. And the momentum here is real. They just crushed their Q3 earnings, raised their guidance for the whole year, and announced a huge $1.8 billion buyback plan. Plus, they have an investor conference coming up on November 19th that could be another nice little catalyst. Now, are there risks? Of course, things like regulatory changes and labor costs, but their recent performance shows they are managing those incredibly well. Okay, idea number 2 is Ralph Lauren, ticker RL. This is our cyclical play, and it's designed to capture that strong holiday spending that's just around the corner. The company is in the middle of this brilliant strategy to elevate its brand, and it's working. They're attracting a whole new, wealthier type of customer. And don't just take my word for it. The results, they speak for themselves. They pulled in 1.9 million new customers in just one quarter. And these are younger, higher value shoppers who aren't as sensitive to price. This let them grow revenue by 11% and earnings per share by 16% last holiday season. That's exactly the kind of momentum you want to see heading into the end of the year. And for our final pick, we've got Cirrus Logic, ticker CRUS. This is our long-term secular growth story. The best way to think about them is as a pick and shovel play for the AI revolution. They make the critical audio and power chips that are becoming more and more essential as AI gets built right into our phones and devices. And this is where the opportunity really shines. Cirrus trades at a PE of around 20. That's half the average for the semiconductor industry. And its financials are pristine. It has more cash than debt, and it scores a perfect 9 out of 9 on the Piotrowski score, which is a key measure of financial health. It's like getting a perfect A+ on your financial report card. This is a really high-quality way to get AI exposure without paying a crazy valuation. So, how do all 3 of these ideas fit together? Because this isn't just a random shopping list of stocks. It's a diversified playbook built for this very specific moment in the market. Here's how it works. You've got UHS as your defensive anchor, giving you stability if the economy gets rocky. Then you have Ralph Lauren as your cyclical engine, perfectly positioned to capture that powerful holiday spending tailwind. And finally, you have Cirrus Logic, giving you a ticket to the massive, long-term trend of AI. It's a really balanced approach for a pretty complicated market. And that leaves us with one last question to chew on. This whole rally is being fueled by what the big institutional investors are calling FOMO. That's the fear of materially underperforming the market. So in a world where the market mechanics are pushing prices higher despite all the macro risks, is the biggest risk of all just sitting on the sidelines and doing nothing? That's the tension every single investor has to resolve right now.